Good afternoon, good evening. Great to be here. We've decided we're going to skip the intros. You can just Google us. And we'll just go to the elephant in the room, which I think, at least my impression is, has been under-discussed, which is, FTX and Binance. And just as an opening remark, I mean, personally, I'm so effing tired of people pretending to run a first-class business in the first-class way, and then it just turns out to be completely different. And it's actually a macro event because it's, something like a Lehman type of moment for our space. What do you think, Dan?
Me?
Yeah, you.
Well, hello, everybody. I know, cheery moment today, right? Everything is coming under attack and imploding even as we sit here. Look, I think that there are bad actors in every business. I was saying before to you, I think, the commingling of funds, if that indeed did happen, is super negative, and yes. I think will bring a lot of scrutiny. But look, in every business, even outside of crypto, there are bad actors, and certainly our job, or my job as an investor, is not to invest in those companies. And so, just in my own experience, last year we passed on over 100 different companies. And many of those companies are now not around. So, look, it's trust but verify. And, I think it's, we don't really know yet. I'm a little hesitant to talk about it because we don't really have the facts. I just heard rumor there was a $10 billion hole, but I don't know if that's true. So I think within the next few days we'll know more, but clearly a lot of bad leverage in the system.
Yeah.
And,
I guess whatever way that plays out, whether that's, Binance actually following through on the agreement or letting it drop, we don't know that because, like you say, it's a dynamic situation. But regardless of the outcome, it is a defining moment because regulation is going to be more stringent, I presume. In a way, we've got the decorrelation that a lot of people were asking for all the wrong reasons now.
Yeah, but the question is regulation by who? This is a decentralized global business. Is it just the U.S.? Okay, so if the U.S. increases some sort of regulation, what about the rest of the world? There is no global regulator, right? So look, the good and the bad thing about, you can hear me, hello? The good and the bad thing about crypto is that it is pure capitalism. There is no one coming in to save. There's no government. There's no large, a bank. And crypto, blockchain, Bitcoin has lived through this before. Maybe not to this degree, but I think it's weeding out the bad actors is fine. So thankfully we have not been hurt in this, but I know a lot of people have, and that's difficult, but and they'll learn and it'll improve next time. So,
and hopefully we'll get stronger. Jordi, what do you
I think clearly we are early, not just price-wise, but in the sense of nobody knows what the hell they're doing in the room. There's no adults. We expect tier one, like you said, kind of institutions to be run properly. And we are so early that we're still figuring out the right way to set all these industries up. I think there's obviously going to be a lot of Bitcoiners who are going to say this is kind of proof of the whole, not your keys, not your coins, self-custody, and a lot of decentralized exchanges potentially will start to get traction because you'll have proof of reserves. It is completely mind-blowing to me. Like 48 hours later, I still can't believe that FTX customer deposits are not available quickly to withdraw, or even possibly at all to withdraw. I think a lot of us are shocked in the industry. I do think we'll, eventually bounce back. The one thing that's been clear from all these cycles is that fundamentally there's a lot of demand for digital assets. People want to hold digital assets, especially young people. They're not talking about, gold and bonds. They're talking about cryptos, and it expresses the digital age, and it expresses the way that business happens online. So one way or another, the industry's not dead, but At the same time, we will have to learn a lot from these mistakes.
I have the...
No, yeah.
Okay, it works. It's not getting killed. It's definitely a setback. I mean, talking to clients this morning, I mean, it's clearly understandable that they're going to get off my lawn. You know, I don't really want to talk about digital assets right now. And I kind of smelled it on Sunday. I was withdrawing a little bit of Bitcoin from FTX because I trade on FTX. And like I've done that before, just putting it onto Ledger. It always worked within 30 minutes. And 18 hours later, it just hadn't processed. So I kind of like, oh, wow, I got it done. But then they stopped, right? So it is a negative, you know, for my business, for an asset management business, for your business. Jean-Marie, how are you? Are you affected by that type of stuff, or are you completely out of it?
2022 has been a difficult year in terms of news flow, and you know, we're coming from the commodity background, and I can't prevent to think about Brian Hunter, who defined natural gas market when he exploded.
Yes.
You can think about Enron and the oil market, and you can think about metal gas shaft, and every single time there was a poster child of their time and of their industry. And better governance and better things came out after that. So, you know, Sam was a poster child for the last 2 to 3 years. What has happened has clearly transformed the industry. As you said, it's a setback for a lot of investors who were taking confidence to see, you know, names, you know, global, you know, Tiger Global, SoftBank, you know, like big names investing behind, putting massive valuation, justifying valuation to some degree. And that was building confidence. You know, you get big asset manager coming in the ecosystem because they're feeling we're missing something. If this other guy are doing it, what are we not doing correctly? And we are now at this point where we're going to redefine what is a proper run business. You know, Dan was talking about who is regulating that and how do you regulate a global business this way. I think Bitcoin and crypto in general all the time has been very good at self-regulating itself and self-policing. Few difference, you know, if you remember Bitfinex in 2016, like sounds like decades ago or like very, very long time ago. They shut down at 4 o'clock. The market was 650 at the time, and by the time within 15 minutes it was like 450 or 420. The market reaction to that is very different, except for FTT today. Like the maturity in the market is very different, the liquidity is very different, so it's not going to disappear. We didn't define really what was the problem with FTX. You know, is it a solvency problem or a liquidity problem? So it's a duration they have in the book, which is at play. It doesn't remove the problem of playing with customer fund, and the commingling issue that Dan is mentioning is tragic. But you know, that the answer to the problem would be very, very different once the problem is identified and shared. You know, like we can speculate a lot. Not many people knows exactly what's happening behind the door. CZ is far well known for being the guy calling the shot, so he's probably doing that himself at Binance and running this discussion. Not sure who's running it from FTX side, so time will say, and hopefully we get some form of resolution, because you know, ultimately there is something to sort out. FTX remain a good asset, you know, just as a technology play, and there's something there to buy. There's a customer base. There's plenty of things to think about when you look just at FTX as a company. You know, the management can go, but you know, what is there can be transformed and grow back.
Look, I think they have fantastic technology. I like using their app. There's nothing wrong with it. But let's move on from FTX, because it's really nothing that we can speculate about it, but you know,
it's all speculation.
We know the next 48 hours will be all the wiser. But clearly, I mean, it is a setback, as we have said, during a crypto bear market where a lot of things are already headwinds. Like investors' portfolios are largely on fire, be that 60-40 or the NASDAQ or a strong dollar and inflation and higher rates and the entire macro construct and a war. And then you have something like that, which is kind of like, oh, here's another kick into a place where it really hurts. But maybe let's talk about the macro, because that's actually the topic of our panel. It's not what's going to happen to FTX. Where do you see something change? I mean, Dan, do you think it'll have to do with central banks? Have they tightened too much? Have they not tightened too much?
Back to the old line, macro. Try to find macro. Yeah, look, I mean, I think it's been pretty clear, at least for a few months, that all the forward-looking data in the U.S. is showing a pretty severe slowdown in growth and inflation next year. So, this is the first time, at least that I can remember, and I mean, at least 30 years, where the Fed has focused its policy on the two most lagging pieces of information that we get, which is the unemployment rate and the CPI. All the leading indicators are suggesting a pretty hardcore slowdown, and this is the only Fed that I can remember that is basically continuing to raise, even though there are very clear signs of a big slowdown next year. And again, they've made two mistakes already. They've got caught. The CPI hit 8.3, and they went, completely the other way. This was early in the year in March, and completely the other way in terms of being aggressive. And I think they have over-tightened, and they'll do it again, and the yield curve will get more inverted. And I suspect the economy, especially housing, is going to be completely annihilated. U.S. mortgage rate at 7.5%, the whole industry shuts down. So it's just that it's taking some time to happen. But I think the Fed will have to relent, and it's possible that the dollar's already peaked. I mean, because the dollar is very sensitive to this, and the markets are beginning to sense that there's too much data. This is the most obvious coming slowdown that any macro guy has ever seen. And so the markets, which price things ahead of time, I think are starting to show that. And that'll, I think, eventually be supportive for crypto as well.
Like you say, the leading indicators, they're all pointing south. CPI is pointing south in Q1 next year. But you think he's going to do another 75 bigs just to have
I don't
his
think
Volcker
it matters.
moment?
I think that the market sort of priced that, and I think it's a matter of how much the yield curve inverts. So the 10-year will continue to rally. The yields, I think, will drop over the next 6 to 9 months for sure. So regardless of what he does in the front end, and then I think he'll end up having to reverse.
So I actually share the same opinion, but when I tell that to my friends, they're like, hey, Moritz, what you're forgetting is inflation could actually be way stickier. So you have CPI pointing down and growth slowing down, but what if inflation is going to be so sticky because of energy is still, remains high and shortages, that type of stuff, and therefore, they just cannot relent. They will keep on being hawkish.
I think, first of all, the right medicine is not necessarily rate hikes. And they're doing a lot of rate hikes. Nothing's been happening. There is a lot of other tools. We're in the UK, and actually I've been following the UK situation pretty closely. I think, Liz Truss kind of showed us what the worst macro policy you can have, worse than anything we've ever seen, where she just came in and said, we're going to have free energy, no bills, you don't have to pay any for anything, and we're going to cut taxes, we're going to just unleash stimulus, as if she's trying to front run a recession that needs to happen anyway. But we actually somehow got adults in the room. The system kind of fixed itself through the pension threat, which obviously, at the end of the day, most voters are going to eventually receive a pension, and if you take that away, they're going to change their tune really quickly. So I think right now in the UK, we're seeing very proper policy, which is I think what the US should be doing. Using fiscal policy. So, tax hikes sometimes can slow down things a little bit. We had Trump implemented, corporate tax cuts, which the Democrats tried to get back all the way, and they couldn't get that through. It only went kind of partially up. I think that would be a much better tool for slowing down hiring, just kind of going straight to the problem with a scalpel instead of using interest rates, which is just such a blunt tool. It has all these other knock-on effects of liquidity and then treasuries. Nobody really knows when treasuries are going to give in. We saw it in the UK, and then we've seen signs of it in the US. I trade a lot of treasuries, and I see the liquidity. Once you go past the 5-year in the back of the curve, it might just give out at some point. There might be an auction, and nobody wants to buy 30-year when they have no kind of visibility as to how that's going to perform. So I think ultimately they will be forced to pivot. I don't think we're going to see another 75 because they are starting to get rumblings inside the Fed that, let's slow down. Maybe we can do 25s for a while and see what happens, but I think we're kind of reaching towards the end of the hiking cycle.
Let me bring it back to the crypto, Jean-Marie, and tie it up for you. If what we're saying is true, that at some point, we're going to see lower rates again, less inflation, all of that, is that going to be the tailwind for crypto? Is that going to be ending our bear market?
Well, the question is, are we going to see inflation dropping back to previous level, or to settle in a level which is higher than what we know, but supportable? So in other way, is the Fed able to take your money away, but at a more acceptable rate than 10% a year? And I think when people start to realize that the inflation metrics are not really read properly and understood properly, the interest of crypto as a potential reserve of value for themselves, for individual investors, become very apparent, and that's when I think you get another tailwind into crypto, when people start to say, hold on, wait a second, what are people telling me, and what is really happening to my savings? And that's when you see the, talking before, decoupling happening, all these kind of elements happening in crypto. So time will say, but we're in an industry where we need to be positive about it. So,
well, look, we just don't know. That's the thing, right? But let's just imagine we're at that point, at that low point, and the markets turn around. I mean, what crypto assets do you think are going to be the most sensitive to that turnaround? In other words, have the highest beta to the top side? Would you say that's the time to be long Bitcoin because Bitcoin has kind of underperformed relative to Ethereum, or it's more like an Ethereum play? I mean, what the heck does that even mean? Like when people say, oh, we're going to be exposed to blockchain technologies, well, if you buy Bitcoin, you're exposed to one iteration of a blockchain technology that happens to have a gold narrative or digital gold narrative for the time being, which is a meme and maybe changing over time. You can do this with Ethereum, and yet it's like a smart contracting application that you're then exposed to. That doesn't mean that you have broad-based DLT exposure. So how would you, if you just imagine a paper portfolio, position that for best growth once we've reached the bottom?
Well, we look a lot at diversification play in crypto, and the power of diversification over the years was not that strong. Now, I think it's a question of what do you buy. If you're looking at reserve of value, people would definitely go for Bitcoin, and ultimately there is a function of allocation which is part of the market capitalization of the underlying, so people will follow that. Now, if you buy Ethereum, you're buying the tech play as well. There is like the whole technology pricing, which is completely missed right now with Ethereum, about this massive internet computer, which is changing the way businesses are built. Like all the decentralized app. If you look at things like SushiSwap, Aave, all these massive applications which are built on, or Uniswap, which are built on the Ethereum network. This is not priced in. Like if you look at the revenue which are generated through that, and start to add that back in the metrics of evaluating Ethereum, or what is the real value of Ethereum, you see a completely different picture. So I think you need to almost cut in half the way you look at it. One way you get your reserve of value, and then you have the technology play, which is completely not looked at right now because people are just focusing on reserve of value.
How about you, Jordi? Are you a Bitcoin bull, Ethereum bull, everything bull? How would you do it?
Those two. So I think Ethereum is going to have this like amazing flywheel based on the deflation narrative. Once the system starts to get liquidity in again, we will see that flywheel take off. Basically, we saw the equivalent of a halvening or multiple halvenings during a bear market, which is not really the time where that narrative can play out. So it went up, and then it was just to sell the news. So I think when we actually reinflate, it will probably be like a very well performing asset, probably better than everything below Ethereum. In terms of Bitcoin, it's kind of binary in my mind, and I'm looking forward to getting some of Dan's thoughts on it as well. But gold has obviously underperformed the last years compared to what people were expecting back when interest rates were very low. Obviously now it has the headwind of not being able to match 5% yield. I think ultimately like Bitcoin is trying to position itself in a similar way, and in my eyes, it's all about narrative. Because it's a coordination game. If Bitcoin's narrative does pick up, it can be extremely powerful. If people just kind of stay focused on other things and not on hard money, and inflation is not really kind of a problem to be solved, because ultimately Bitcoin is a solution to debasement. Then if you just kind of get into technology and Ponzinomics and all this kind of stuff, then you have to kind of look at Ethereum as having that flywheel now.
Dan, in your world, does Bitcoin play a role? I mean, the debasement argument I think is a great one. That is the one that counts for me. But you're with 10T. I mean, does Bitcoin play a role, or do you go like, oh, everything is in venture?
Well, so I mean, the way I see it, there's Bitcoin and Ethereum. Those are really the only two proven assets. Everything else is an experiment or venture investment. We don't really do venture as far as I see. I mean, 10T we've invested in, we're growth equity, mid-stage companies that have revenue, between at least minimum 50 to 100 million in revenue. So we don't actually own any of the tokens. Of course, many of the tokens are owned on balance sheet of some of these companies. But for me, the most important thing in this space when I launched this thing was to solve for volatility. I mean, the key is to be able to be stuck in, to hold on, to be in the space for 10 years and not get blown out. And so that's why I launched a 10-year life private equity fund. I wanted to be long the businesses in the space that were going to be leveraged to growth in the overall ecosystem. I didn't want to bet on any single blockchain or cryptocurrency, just because I didn't really have that skill set, and the guys at Andreessen and Polychain and all of them, they've got, programmers taking apart each chain and deciding, which is going to be better for this thing or that thing. That's not really our skill set. So I don't look at this world in the way that you would. I'm not looking to be the number one performer. In fact, we definitely will not be. The kind of returns I'm trying to make are, let's say, 5 to 10 times over a 10-year period. But compared to some of the guys who are running liquid token funds, they were up, 10x last year. But on the flip side, we're not doing that badly this year, and we're doing okay. So, I felt like, our strategy, and this is your question, how to play for the upside, may underperform on the upside, but we're, outperforming, I think, on the downside. And so I don't have any fear. I'm not worried about FTX or SBF or any of that. I'm just not. It's not, and I'm not trading either, which I think is extremely difficult in this space unless you're a real pro. This is not for civilians. So I think really, if you really want to make the money in this space, it's about how you structure your investment so that you can sleep well at night. And that's it, really. And just get stuck in and don't let the swings drive you nuts.
And that's what we do, 10 years, lock up, but you have less volatility than VC.
Yep.
But do other assets, TradFi assets, play a role for you still?
No.
I mean, the old...
No, because, on a long-term basis, they're just not that interesting. I think gold is the best hedge for the old system. So, you started to see gold pick up a little bit because it's sensing that growth and inflation are going to be softer next year. The dollar softened a bit. I definitely, this inverted yield curve will lead to a gold rally. Liquidity, the Fed has been tightening pretty severely, and so gold came down, as it normally would. And gold, I think, will be a good return, will provide a good return in the next sort of 18 months or so, but it's not anything I'm focused, I focus on it. It's hard for me not to think about it and look at it. I have my Bloomberg, and I see what the markets are doing. But I don't think those opportunities are interesting compared to what's in front of us in this space, even with SBF and all this nonsense. I think this is the greatest macro investment I've seen in 30 years. It's the digitization of value. I don't know what's a bigger trade than the digitization of all value. And so that's how I'm trying to play. I just want to capture it, right, and not get shaken.
Right.
Yeah.
So it sounds like you've placed your bet. I'm still trading all sorts of markets because I find it interesting. You sound like you've placed your bet.
Well, I'm much older than you, and I did all that interesting stuff. And I like to maximize my energy input to profit output. And so I've decided not to be active in this market, because in the crypto space, because to be active would mean to have a team of 20 people and be around the clock, and you could earn a certain return and maybe a high return. But that really isn't the way to build wealth, in my view, on this structural change. It's to be long the companies and businesses that are winning and do something unique and special, and are going to be around 5 to 10 years from now. And in the old world, there's it's very difficult to have a similar type of risk-reward profile. And you also have thousands, if not hundreds of thousands of competitors. As far as I know, still today, 10T is the only growth equity fund that only focuses on crypto, blockchain, businesses. So that's kind of crazy. I'm sure there are going to be more competitors, but why would I do anything else aside from that, right? I tried treasuries against 100,000 people globally, all those eyeballs on the Bloomberg. I did that in the 90s and 2000s, and that was great. But to me, that's not a wealth-building exercise.
I get it. And so, Jean-Marie, you have the commodity background. You look at natural gas, is that still something that you can't stay away from because it's just moving so much?
I stopped trading commodities in 2013 and focused solely on the crypto since then.
So
I just
made the change.
A bit like Dan, I just said, I need to turn the page, and I'm embracing a new paradigm. So it was from one story to another. So turn the page.
Clear cut.
I'm still following, I'm still looking from time to time, but I'm not trading.
Jordi?
I still trade traditional markets as well. I find them fascinating. I guess I'm not as many decades in, where I've kind of seen that, done that. Yield curve inverts, goes back. I do think that a lot of my thinking around crypto came from macro. I first got into crypto looking for, first I had all my money in gold. I would earn my bonus, and I would just buy gold futures, and I would pay that every month. I would have to, you pay some discount as you're rolling the futures, and I would just accept it as this is kind of an acceptable way for me to avoid the fiat game. And COVID hit, and I realized gold is actually probably not great, because first of all, central banks own most of it, the major ones, so they can determine what happens with the price if they have it. You can't really custody it. You can't know how much there is or how much there's going to be. So getting into crypto from that mindset is a very pure way to kind of open your eyes and accept that there's some solution that can be found here. I still think, for me personally, it helps to look at interest rates and look at exactly what the government is doing, because last year, the only way I could make sense of the crypto markets was looking at how much liquidity they had pumped in, and realizing that this is just money that doesn't know where to go. And all the valuations are crazy, but it's because what's the alternative? There is no real place to go.
China. Yep.
Yep.
Stimmy checks, AMC, GameStop. All of that happened. But hey, we have less than 10 minutes left, and we decided to invite you to ask us some questions. You can really ask us anything if you want. We're not promising any answers, at least not good ones. But I thought that would be more interesting. If you have any questions on macro, crypto, whatever, just shoot away. Does that sound good? There we go. You get a mic.
I know you don't want to talk about specific quants, but the primitive of Ethereum, the fact that there is application layer being built on top of it, do you think that it's inevitable that eventually the flippening will happen?
I do have some views on the flippening. I think there's way too much talk and focus on it. Things can flip and reflippen. They're totally different assets, and they can outperform in different environments. And I don't think that a flipping will necessarily mean, Bitcoin is dead and king Ethereum forever. If you use first principles, first of all, if there is a flippening, even if that lasts and Bitcoin does go down, there's no reason why there is not going to be a reflipping of something else, like something else comes on. And I'm not saying that it exists. It might not be like one of the existing top 10 coins, but somebody comes up with a new technology, it's just a lot better programming language, and that flip-ins again. So I don't know that it's good to think about in these terms, and I don't like that people focus on this kind of competition. I think these are mutually, there's some overlap in certain ways, but they are quite different assets. I mean, especially now with proof of stake, it's just completely different asset. The amount of censorship resistance can be comparable, but it's very different type of censorship resistance. So I do think it's possible that in a flywheel effect with a lot of liquidity, Ethereum comes up, but Bitcoin has something unique that it will never lose, which is kind of its provenance and being first and having that Schelling point. So it can always come back, and it really just depends on where society focuses for that decade or for that period of time.
You want to say something? Otherwise, I could just say, if I may, I don't really care about it, to be quite honest. I'm long both. I think Ethereum has something going for it. It's going through a lot of change. It has gone through a lot of change. It will go into sharding next year, probably. And look, it's the largest smart contracting platform. A lot of these exciting applications are going to be built on it. It's potentially less inflationary, potentially deflationary. That by itself actually will give us some monetary value. So I think the outlook for Ethereum is really positive in the long run. And whether it's the larger asset or larger than Bitcoin, it's really whatever.
I mean, the key is that they both grow.
Yes, and I think that they will.
Yeah, me too. Yeah.
They will both grow, but I think actually the flipping is like a very TradFi argument, and it's like being number one, number two in the Fortune 500. It's just an argument for the CEO. Nobody cares if you're number one, number two in the Fortune 500, but the CEOs. So I think here is really a tech play, and I like both for very, very different reasons. And as Dan said, and as everybody in this panel says, it's about they can both grow in very different manners and answering very different needs.
Next question. Nothing? Come on.
Okay, time for
There we go. There's one. Yes, Shai. There we go.
Okay, so talking more about macro economy, to what extent do you believe that this recession is going to reach? Are we going to see something that happened in 2008, as Dan said, with housing market crash, or are we going to see more like 1920s, 1930s scenario? What's your speculation on that?
I mean, look, I'll respond right away. I mean, I think it's, I don't see a 30s situation. I think that part of the difference is, we still have this framework of the Fed, responding to major crises. I don't think that's going to go away. I think when the data slows enough for them, or we have a proper financial accident, I think they'll respond. Also, look, we have more gross outstanding debt today, certainly, than in the 70s, and more than any time ever. This is another reason why I don't think it is the 70s. Things will slow more, and there's too much debt for them not to bring down the interest rate. I mean, there's some crazy studies out there that show if the rate stays at 5 or 6%, what it does for total, world interest payments. It's just absurd. That being said, look, I don't think bringing rates down back to zero again is necessarily a healthy thing long term. I don't know that rates should be there, but I think if they have to be there, that they should be there. And and I don't see why any Fed wouldn't accommodate that. So again, what I think is more likely is that they've over-tightened, things completely vaporize, they then cut in panic again, too much, and then we go all the way back up on another inflationary type move because they've overdone it and you're starting to get defaults. I mean, what happened in the UK, you should talk about a little bit. The back end of the yield curve basically stopped trading. And that was the first shot across the bow that told you that there were new things coming. And I think gold started to respond to that as well, that there are going to be other events. And arguably what's happening in crypto would not have happened had it not been that so much liquidity was pulled out of the system. So I think it's greater probability that we have increased volatility in the macro cycle than I do a 1930s, it's bad forever.
I've thought about this a lot over the last few years, ever since COVID especially, where you start seeing K-shaped recoveries, the so-called kind of, divergences, and I think it's not going to be 1930s, it's not going to be 1970s. This is like a unique time. One of the things I've noticed over the years is every time the Fed bails out, inequality increases. Because the system by which they reinflate the economy really helps certain segments of asset holders, really helps like certain segments of people being kind of close to the source of the money, so-called Cantillon effect, which we've seen historically. And I think increasingly the amount of inequality and kind of K-shaped divergences starts to play out politically. Like we saw this with Donald Trump, we saw this with Brexit, and I think like the political effects of a recession that might not be like necessarily deep for everybody, but for certain segments of the population who just are very unhappy with their economic situation, the government will, in my opinion, possibly have to step in a sort of big government way and redistribute wealth, and that's why I see a lot of more taxation possibly and a lot more UBI coming.
Just looking at the time, if you factor what you said with the election coming into the US, like in 2024, you get like a massive run for election, and American people vote based with their 401k and the wealth of the 401k, so you're going to get some reaction there to support that.
I would want to bring it around to crypto again, because I have this thought that it's possible that if we get this severe slowdown you're talking about, and let's say it doesn't, they don't respond enough and they have a hard time pumping the patient again, that there's a chance that there's a movement away from the traditional world and maybe to the crypto world. I know it seems crazy today to think that, but I think it's a possibility for the Fed in the next cycle to lose some of that credibility that they've had for so many years. I don't know what you guys think about that, but in the back of my mind, especially with people under 40, under 35 who are owning crypto, seeing that as an alternative to 8 guys sitting in DC around a table trying to make a decision and figure out the cycle. If they mess it up again, people might just say, you know what, look, let's go to a math-based system.
But I bring you back to the white paper from Satoshi.
Yeah,
and
exactly.
The quote from Satoshi was all about that, so
that's exactly right.
Bring it back.
I think there's 2 factors at play here. You have central banks slowly but surely losing their independence and their firepower. And that's because fiscal, government, stimulus, all of taxation, all of that stuff takes the front row seat, and central banks have a reactionary function that is less prominent now. And then you combine that, I think, with what Dan just said, is there's a new generation out there of younger people that are currently building a new digital world in front of our eyes. And they are upset with the system that they have observed for the last 20 to 30 years, or maybe only 20 years. And I don't think that they'll be just saying, oh, we accept it. We'll just accept that there's a Fed or an ECB, or look at what the BO. We didn't even talk about Japan, which would have been interesting with, if you are 20 today, very likely you're going to be saying, screw that. I don't want that anymore. It has to be a different system. And I guess this is what really the long-term view for me is that these tokens and coins, technologies, whatever, math-based, rule-based, cryptographic systems are a way out. They are a better alternative. There is an alternative, which is this, but it's a very volatile path to get there. Yeah. You have? Yeah. Okay, so you have the mic, so you've been granted a question. Final one. Let's go.
Thanks. I have a question. A few years ago, there was a narrative around Bitcoin and crypto that it was kind of decoupled from traditional markets, the stock market. But as we have seen since COVID with low interest rates and now high interest rates, how the crypto market is crashing, are we see that crypto is just an integrated part of traditional finance and macro, and it's the Fed that's deciding. It's not decoupling from traditional markets. Is that what we're seeing now happening with crypto? It's all part of the same big market movement.
Well, I don't think it is. I mean, look, Bitcoin has become more of a real, I would call even more established asset. And so, yes, it's going to move, and Ethereum as well, a little bit with ups and downs of liquidity, mostly because I think there are futures for both of them. And so now you have, I was in the hedge fund business for 25 years. You have hedge fund traders who trade futures, and it's part of their portfolio. And so when liquidity comes in or goes out, it impacts them. But over the long term, I think there's zero correlation between Bitcoin and, let's say, the S&P 500. And I always say, in the last 10 years, Bitcoin is up 99.9% against the S&P future. Every asset in the world is devalued massively against Bitcoin, Ethereum, and some of the other, leading tokens. And so I don't know that the next 10 years will be so severe, but I think it'll continue to be that way. So
I have a slightly different view, which is definitely until now, we do have this correlation. And part of the reason is Bitcoin is a piggy bank. People kind of put their savings into it. They're happy to kind of put discretionary income, save it in there. And what happens is everybody wants to put money in the piggy bank at the same time, and then everybody wants to take it out and break the piggy bank at the same time. And if there's no kind of structural code that limits, like a good idea would be something that as more people put in, it just prints more, so it dilutes it and it kind of keeps the price a bit steady, and then maybe uses that money to buy back when price falls back down. Because currently the way it's constructed is indeed like everyone is kind of wanting to go in the same direction or go out at the same direction, and it depends on like how rich or poor they feel, which sadly is just a part of the kind of micro cycle. So I think that I agree with Dan over time that can change, but I do see an element where inherently incentives-wise, there is that correlation.
Yeah, well, I think the correlation element is almost like a fulfilling prophecy. The whole industry wanted to get the institution to come, and yeah, okay, so let's say you get Tiger Global coming in, but Tiger Global come also with its risk management team. And the principle of risk management they apply to crypto is the very same they will apply to any stock or any position in the book. So you're down 10%, you're out, you don't fall in love with the position, whereas any crypto hodler would be very happy to say, okay, I'm down 25%, 50, 18, doesn't matter, it's like I'm here for the long term. So you end up with this kind of massive asymmetry of expectation between the institutional money you expect to be there to bring liquidity and their real management of this liquidity, which recreates naturally the correlation because they apply to all the asset class in the very similar manner. So, I think it's part of the, it came with what we wanted. We wanted institution to adopt it, and by having institution adopting it, de facto we created this similar risk management framework, taking it away from the, people who believe in Bitcoin and see they are true believer versus the people who just trade it, and that's kind of quite the difference.
All right, so you've got all the smart answers. I could only screw it up now, so I'll shut up. Thank you very much, ladies and gentlemen.